So, given the fact that your core assets in the home country is solid, the home country looks like it's going to withstand the current crisis in America, in Europe, and so on. How is your exposures in the emerging markets that you're in at the moment? Because on the trade finance front, on your lending front, how does your funding base look like? How domestic do you need to be in the countries that you're doing business in right now?
Well, and it's very important that in most countries, not all, and it's a little bit different in Asia, we can talk about that, we try to be very much a local bank. We are not a global bank, and this is very important. We're a local bank providing products and services, whatever they are, and they're different, slightly different in all countries locally. And so we're a local bank. And we've chosen, as I said earlier, I think fairly wisely, so our countries that we're in, even though if global growth is only less than 4%, the countries we're in are going to be more. And you know, growth is we all aspire for growth because that's how we get jobs and that's how we get growing economies. So those countries we're in, we're local, providing services. Under any scenario that I see, maybe the level of growth, you know, will be volatile, but it's going to be superior than G7. And so I think, so as we see in the picture we get right now, and we just announced our 9-month earnings, and they're very good earnings, they're strong, and you can see by all the risk parameters, very strong on risk. Our customers in Canada, in the emerging markets, both the retail and the commercial, are in good shape.
Out of curiosity, as a CEO and from a business perspective, how do you keep a one view of your various portfolios, assuming that you're very successful as a domestic bank in the markets that you're in? What do you look at on a daily basis to make sure that firstly, you know, your various assets are safe, the risk aspect is correct, and that they're profitable, and that they are good performing assets in that sense. How do you run a international franchise? You know, what's the mind of the CEO when you're looking at a franchise internationally?
Well, again, I've been around, and our management team have been around a long time, and so we have information systems, and we have a culture that of information comes very quickly to the top, even though we rely very much on our people out in the field, whatever that is, and that's an important thing. Now, specifically, though it does depend on the product. So when I mentioned that 90% is real world, I mean, so we got 5% that are in trading. That's a different. So that's sort of instantaneous. You use your technology, your MIS, and our things, so we know where our trading positions are. Okay, and that is, and it has to be, you know, fairly quick, real time, and what have you. Now, the day-to-day banking businesses, which is more the real time to know what our position with an individual is today versus a week from now, is not absolutely essential. Having said that, we track delinquency, 30 days, hardcore delinquency, 90, and we have all this reporting, and it does come up. But it's not the real time that you have on the trading. And so you just build these systems up over a very long period of time, and the last thing is you really rely on your local people and their reporting and their checks and balances.
The reason I asked the question is that you seem to have a very cozy relationship with the analysts. The analysts understand your business. They understand the far-flung nature of your franchise, and somehow they seem to recognize that on your book. So when you report your quarterly results, they know what to look for in that sense. So to you, in order to be able to give them good news every quarter, there should be some kind of a funds transfer pricing type of a mindset, making sure that, you know, the allocations of your
capital. We spend a lot of time on capital allocation. You know, we're very profit driven. We're very efficiency driven. So, you know, productivity ratios. We have a whole set of metrics, financial metrics, that when we negotiate our budgets and all that kind of stuff. Now, the comfort they get is not me just talking to you, and hopefully they do, because we are very transparent. We try to be, you know, as we can. I'm not on competitive information or customer confidentiality, but when you look at where they get their comfort is our track record. And if you look at our return on equity, our profitability, you look at our efficiency, our productivity, you look at our credit history, our risk management history over 1 year, 5 years, 10 years, 15 years, 20. Return on equity, we are our world leader. So even in our worst, right now we're at about 18% return on equity. So you got to ask yourselves who's around. But even more important than that is in our worst years, 2008, 2009, our return on equity was 16, 17%. Go back 5, 10, 15, 20 years. Our return on equity is not only high into the high teens, it's very steady. It's very volatile. Go back over 20 years and see the number of times we ever adjusted our earnings. Very, very few. And then lastly, and then I'll finish, look at the total shareholder return our customers have been getting over 3, 5, 10. We are in Canada and in leaders. So the comfort is all on the past, and hopefully the comfort also is understanding, which was your question, the business model, which has worked and proven itself in the real world.
Right, and because in order to maintain that comfort, given the fact that the way you describe it is like maintaining that comfort is paramount in a sense, right? What are some of the things that you would not do as a bank in terms of acquisitions, in terms of businesses that you wouldn't go into?
Well, see, we are very disciplined. A number that I've been talking about recently is during the crisis, we've made over 20 acquisitions. Now, we don't make big ones because we believe in diversification, and we're not going to bet the bank on any one acquisition. But over that, the last 3 or 4 years, we've made about 20 acquisitions, about $12 billion. And we made about half of that, about $6 billion into the emerging markets. Thailand in Asia was one example, and this is before even, of course, the China that we talk about. And then in Canada, through our wealth management, we made about another 5 or 6, and a few other kind of areas. And at the same time, because we're highly profitable, we didn't have to raise equity, and at the same time, we kept our capital ratios very, very strong. Why? Because we make sure anything we do is diversified, doesn't risk the bank, meets our financial parameters, and is on our strategy. And we don't change our strategy very much. We've had a hard look because of Basel and whatever happens, and there's a lot of issues going on in Basel. But we're comfortable enough that we can handle whatever the Basel, the re-regulation, stuff us, and not change our fundamental strategy and our fundamental business model.